Topic 3. Theories of exchange rate determination. Interest rate parity. In open interest parity and assuming no risk premium, F equals at multiple street plus 1. Simplified version will be R equals R foreign plus micros, where F is forward rate, S is spot rate, and positive micros is expected appreciation of foreign currency. Purchasing power parity. 1. Absolute purchasing power parity, PPP. The absolute purchasing power parity theory postulates that the equilibrium exchange rate between two currencies is equal to the ratio of the price levels in the two nations. R equals P divide P asterisk, where P equals domestic price level. P asterisk equals foreign price level. Implications are: inflation leads to increase in exchange rate, depreciation. Reflect law of one price, also known as Big Mac exchange rate. 2. Relative purchasing power parity. The more refined relative purchasing power parity theory postulates that the change in the exchange rate over a period should be proportional to the relative change in the price levels in the two nations over the same time period. Specifically, if we let the subscript 0 refer to the base period, and the subscript 1 to a subsequent period, the relative PPP theory postulates that new exchange rate R1 equal to the previous exchange rate R0 multiply the ratio of domestic P1 divided by P0 to foreign P asterisk 1 divided by P asterisk 0. For example, if the general price level does not change in the foreign nation from the base period to period 1, i.e., P1/P0 equals 1, while the general price level in the home nation increases by 50%, the relative PPP theory postulates that the exchange rate, defined as the home currency price of a unit of the foreign nation's currency, should be 50% higher, i.e., the home nation's currency should depreciate by 50% in period 1 as compared with the base period. 3. Weaknesses of PPP. Firstly, the Balassa-Samuelson effect. Productivity, and therefore wages, in traded sector of developed nation, is higher than developing nation. Wages in non-traded sector tend to equate wages in traded sector, hence causing overall price level higher for developed nation. As a result, PPP tend to predict overvalue exchange rate for the developed nation. Calculated PPP value is wrongly lower than actual rate. Secondly, possible factor that can cause deviation from PPP is international commodity market less integrated due to transportation costs, actual or threat of trade protection, information costs, and limited labor mobility. 4. Disturbance and adjustment towards PPP equilibrium. Monetary disturbance. Referring to the diagram. Example, increase in domestic money stock will lower domestic interest rate. Then, capital outflow, causing depreciation of domestic currency. Move from point A to point X in the diagram. At point X, domestic currency is too cheap, undervalue. Domestic products more competitive. Thus, foreign demand for domestic product increase. This will cause price of domestic product to increase. Moving point X to a new equilibrium point on the same PPP line like the point B. Therefore, a monetary disturbance did not change the proportionality between exchange rate and price level. 4. Disturbance and adjustment towards PPP equilibrium. Real disturbance. Referring to the diagram. Example, assume world demand to domestic product increase. This will cause excess demand for domestic output. Hence, new equilibrium price increase. Due to better term of trade, the PPP line pivot upward, see diagram. Real exchange rate decline. In another word, real appreciation of domestic currency. In the diagram, point A could move to any points on new PPP line. for example point D or point C. Therefore, a real disturbance could change the proportionality between exchange rate and price level. Monetary approach. Demand for money can be formulated as MD equals K multiply P multiply Y. We use asterisk to represent foreign and no asterisk means domestic. MD equals quantity demanded of nominal money balances. K equals desired ratio of nominal money balances to nominal national income. P equals price level. Y equals real output. Assumption used is that domestic and foreign bond are perfect substitute. Solving some equations as shown and applying PPP definition of exchange rate. Where R equals domestic price level divided by foreign price level. Formula for monetary approach in exchange rate determination is R equals M multiply K asterisk multiply Y asterisk and divided by M asterisk multiply K multiply Y. Generally, K and Y are assumed constant. Thus, under flexible exchange rate, changes in R is subjected to proportionate changes of domestic money supply, MS, and inversely proportionate to changes in foreign money supply, MS asterisk. Note that the monetary approach is dependent to PPP theory and the law of one price. R equals P divided by P asterisk. This approach did not consider the role of interest rate, which could be explicitly analyzed using the interest rate parity approach. As for further analysis on fixed exchange rate, component of money supply could further divided into domestic component of the nation's monetary base, D, and international or foreign component of the nation's monetary base, F. Thus, MS equals M multiplied by the sum of D plus F, in which M is the money multiplier. Portfolio balance approach. This model also called asset market approach. Domestic and foreign bond are assumed as imperfect substitute, where foreign bond involved extra risk, such as exchange rate change or country risk. Thus, there is a risk premium element in uncovered interest parity. I equals I asterisk plus EA minus RP, where I equals domestic interest rate, I asterisk equals foreign interest rate, EA equals expected appreciation of foreign currency, and RP equals risk premium. Equilibrium in each financial market occurs when the quantity demanded of each financial assets, money, domestic bond and foreign bond, equal its supply. From these understanding, we can formulate the function for each of the following. M equals demand for money, D equals demand for domestic bond, F equals demand for foreign bond. Other factors are Y equals real income or output, P equals domestic price level, W equals wealth of nation's residents. Their respective expected relationships are as shown in the three functions in the slide. Dornbusch exchange rate overshooting. Refer to the 4 panels diagram. Panel A. The Malaysian money supply unexpectedly increases by 10%. From RM100 to RM110 billion at time T0. Panel B. The increase in the Malaysian money supply immediately leads to a decline in the Malaysian interest rate, from 10% to 9%. Panel C. The Malaysian price index rises by 10%, from 100 to 110 gradually over the long run due to sticky price effect. Panel D. Exchange rate of the ringgit, R, immediately rises, the RM depreciates, by 16. From RM1 per USD to RM1.16 per USD. Thus overshooting its long-run equilibrium level of RM1.10 per USD. It will then gradually move towards RM1.10 per USD by appreciating, or falling, in the long run. As Malaysia prices rise as in panel B, the Malaysia interest rate also gradually rises back to its original level of 10% in the long run.